Silver crushes inflation. In the 1970s, silver was up 3,700%, easily doubling gold's return of about 1,400%, which is nothing to discount, that's for sure. But, being the trade of the decade, I certainly believe that, because I also feel that, and this certainly goes hand in hand, that inflation is going to be the defining feature of this decade. Very much like the 70s, if you look at what took place in the 70s, the inflation was not rising up to a sort of a sustained high level. What happened was it would rise, fall somewhat, not to the previous low, then rise again, fall again, not again to the previous low. So we had three large inflationary waves in the 1970s. And these were in large part caused by central banks that would react to the inflation. They saw inflation, would raise rates, they would back off as they saw the economy sort of start to struggle again. And that would allow the economy to rise again. The inflation would kick back in. They'd raise rates again. That would slow things down again. But each time the wave was a higher wave. If we talk a little bit about the economics of the 1970s, there's something very important to point out. How in the 1970s, a really interesting comparison is that back then, the debt to GDP in the US was 35%. So that meant, much, much more manageable, much lower debt levels allowed the central bank to raise rates because the debt was manageable even at higher rates.
Peter Krauth often points out that today's debt to GDP ratio at 130% is almost 4 times higher than it was in the 1970s. This, he says, is at the heart of what he calls the Fed's dilemma. With the U.S. government burdened by roughly $30 trillion in debt, raising interest rates becomes a double-edged sword. Higher rates mean that paying interest on this debt grows quickly unmanageable, and the knock-on effect on key sectors, particularly housing, is severe. Krauth highlights that housing doesn't operate in isolation. It's the backbone of related industries and thousands of jobs. So, the Fed's room to maneuver is narrow. In Krauth's view, this limited flexibility makes inflation more likely to spiral, creating what he sees as a defining economic feature of this decade: persistently high inflation with limited options for control. Krauth is also vocal about the potential for a silver price explosion, which he believes is primarily driven by investment demand at the margin. He reminds us of 2020, when silver ETFs saw a historic surge in demand, with around 330 million ounces purchased. This rush for silver, he explains, is directly tied to inflation dynamics. Many people assume that if inflation simply slows, the pressure on prices will ease. But Krauth cautions that this misses the bigger picture. Even with slower inflation, prices remain elevated, and unless there's outright deflation, those higher prices become entrenched. In Krauth's words, inflation has already baked in these costs, setting a new, permanently higher floor for everyday expenses, and he believes this will ultimately reinforce demand for inflation hedges like silver.
And so what we've seen with the demand side for silver, especially from ETFs, but certainly for physical silver as well, but from the ETFs specifically, is that as the holdings in ETFs build, it's very interesting to see that even if the silver price falls and can fall dramatically sometimes, the holdings in silver ETFs, they barely budge. And that's something that I've coined silver is sticky money. And we've seen that, and that's going back at least a decade. In fact, it goes back to the inception of the first silver ETF, the SIL, which was the original silver ETF back in 2006, that the holdings have grown dramatically and hardly ever drop. And so all it means is that as people buy into silver ETFs, they become long-term holders. And so in a sense, it's like this silver is quasi-permanently taken off the market. And so it drains the supply in a very steady way. I believe that we've started a new commodities super cycle. This was due to come. I think that the pandemic and the stimulus that came from the pandemic just sort of accelerated and kicked it into high gear. Again, I do go into ways that people can manage risk. One is position sizing. I say that when you buy into a silver investment, to buy into it in tranches, split that up into 2 or 3 purchases to, again, lessen your risk. But I think that the volatility is an advantage that investors have, especially sort of smaller retail investors. We're not bound like money managers are. They have larger amounts that they have to move in and out of stocks. They have to maintain a certain amount of liquidity. They have to buy into stocks that are listed on specific exchanges, and they have to react to liquidations when clients come back and say, I want to liquidate some of my holdings in your fund. We can be a lot more patient as individual investors. Wait for periods of weakness, take advantage of that, look for mispricings. Again, we'll go back to that. There's volatility. Investors should take advantage of that volatility. They shouldn't let it scare them away from silver. They should make it work for them. And there's so much reward from investing in silver. As I said, I talked about the gains that silver produced in the 1970s. 3,700% in the metal itself is a 37 times return. If you can get that in the metal in a massive silver bull, it's certainly not unrealistic to expect 10 to 50, and sometimes even in some special cases, 100 times or more returns in some silver stocks. We've seen that recently with some gold stocks that, have gone from discovery to massive deposits that have been proven out. And that's very, very early in a bull market. So the potential really is huge, and it's not something to be discounted. I really feel like, given the opportunity and the economic outlook, people really need to have some exposure to silver, even if it's a smallish exposure. The upside is just so big for a small allocation to this space. Don't ignore the massive opportunity of silver itself, both from the physical and even from the much lower risk ETFs, mining ETFs, and larger producers and royalty companies.
Peter Krauth emphasizes that it takes real conviction to invest in silver companies and understand where we are in the current bull market, but he says it's definitely worth it. He believes every investor should consider owning some silver, even those who want minimal risk. According to Krauth, even older investors could benefit from buying a few silver coins, perhaps from their country's mint or a well-recognized source. It's something he thinks everyone should own, as it's easy to trade and widely recognized. Krauth also highlights the unique nature of silver. It's both a monetary and industrial metal. He reminds us that silver was actually used in US and Canadian coins until the 1960s, when it was fully removed from coinage. Silver has a long history as money, but in recent decades it's become crucial as an industrial metal. Now, over half of all silver consumption goes to industrial uses, with about 10% going specifically to solar panels, which are vital to green energy. Krauth points out that with the growth of the green energy sector, silver's demand is rising in electronics, medicine, automotive, and renewable energy. All this, he says, makes silver irreplaceable in his mind.